Hello and thank you for listening in to Nomura's weekly podcast series. With me today is George Buckley, our chief UK economist, and myself, Jordan Rochester from the FX strategy side. We've just recently published a piece for what will be quite a market mover, perhaps even as close as next week, for when Theresa May triggers Article 50 next Wednesday. It's going to be met with a European response. Perhaps within 48 hours, the draft Brexit directives will be published, which will set out the scene for the EU negotiators with their unified position as they approach the negotiations. Now, it could take over a month before the actual negotiations start, because we have the French elections to deal with, but also the first EU summit is not until the 29th of April after these Brexit directives will be published. Nevertheless, the market may be pricing for what could be a good or a bad deal, and if so, will Theresa May follow through on her wording of saying no deal is better than a bad deal? So we think the market will care whether this exit and new arrangement discussions will also take place in this sort of manner, but will they be parallel, where you discuss your future relationship with the EU, or will they be sequential, where it's exit talks first when it comes to EU migrants and their rights to stay in the UK, and the exit bill that is quoted that for the UK to owe the EU? Will these sequential process where you talk about exit first before anything else on the future? That'll be a negative for the market, because it increases the risks that we actually eventually see a cliff edge. Whilst it's not our base case, we do discuss in the piece whether this could influence the market moves. Now, George, it's not all about Article 50. We need to discuss the Bank of England too. So from your side, what's the view on the Bank of England after a strong CPI number and also a surprisingly higher number on the headline for retail sales?
Well, I think at the moment, Jordan, that they're trying to look through, and it might not sound like that from those rather hawkish minutes we saw last week, but I think most members are still trying to look through the fact that inflation is rising, because when you have higher inflation and it's due to the currency, it tends to be a one-off impact. You would need to see continuous declines in the currency in order to keep inflation rising perpetually. So it won't last forever. It will be a short and sharp shock to inflation, which we think will do more damage on the downside to real household disposable incomes and consumer spending, that the bank will want to focus more on the impact on growth, on the negative impact on growth, than they will on this near-term impact on inflation. And of course, if we get some of the risks that you've highlighted, whether we see for example, trade not being quite as frictionless as we would like it to be post-Brexit, that some of these negotiations don't happen in parallel, they happen sequentially, so it takes us a longer time to get to where we want to be. Then, of course, there is a risk further downward on the currency, which could push even further higher on the inflation numbers, which, of course, will just inflame this debate about whether the bank should be focusing on inflation or on growth.
George, when we're talking about frictionless trade, I think we just need to clarify. The customs union would be the easiest way to go about that. But is that a reality, or is that something that's just off the table?
I think it's very difficult to know what is going to come out of these talks at the moment. But I suspect that Theresa May has already said that it seems highly unlikely that we will be able to persist with the customs union as it is if we're not staying in the single market. The two really go hand in hand. So the question is, what's going to prevent this Brexit cliff edge? I mean, I think there are a few things which can prevent it. You could extend Article 50, but I'm not sure that's a good idea. You could remain temporarily in the European Economic Area. I don't think that's likely. I think it's more likely that we get some either zero for zero tariffs, or we see some bespoke interim deal being negotiated. But again, you haven't really got much time to do that with only a 2-year horizon. As you said already, there are a lot of political uncertainties in Europe yet to come over the course of the next year, which may even derail that timetable itself. So very difficult to know as yet. All we're assuming in our forecasts is that we don't get that cliff edge, and that we do see some sort of free trade deal eventually agreed, but that's going to take quite some time.
Thanks, George. So I guess from the FX side, for us, we're trying to find a reason to be long sterling, because when everyone else around you agrees with you, it feels a little bit like the pain trade, the consensus trade. The forecasts are still looking for sterling to head lower, but over the last couple of weeks, cable, for example, sterling against the dollar has drifted higher. But from our side, I think it's a bit of a relief rally, but actually something that's not going to continue for much longer. like you said, George, the Bank of England is likely to look through the inflation overshoot, and the data is not really that strong to warrant a reversal of that monetary stimulus we had last year. And if you look at the external accounts on the balance of payments, the sterling is still perhaps even overvalued on a fear basis, even though according to some metrics it's undervalued by 10 to 20% on PPP, the law of one price, for example. But just ask anyone who's been trading emerging markets, such as Turkey, for example. If you were buying Turkey based on the argument of PPP, you're about 176% down over the past 10 years. So in terms of the UK going forward, George, is it going to remain the UK? One thing we haven't discussed is Scotland.
Yes, and that obviously remains a real risk. It really is up to the Prime Minister of, and Section 30 is what she would need to push through if there was to be another referendum. It is her call, but it might be very hard to resist with Scotland wanting that referendum, and or at least the majority of the Scottish Scottish Parliament and the SNP wanting that referendum. It could be very difficult to resist, but I think Theresa May will try and resist it in terms of pushing, at the very least, pushing it back to substantially longer than March 2019, because she's got other fish to fry.
Okay, thanks, George. So thanks, everyone, for listening. And if you'd like to know a lot more about the timeline and the thinking behind the views, please do refer to the piece we've just published called Article 50 and What Could Move Sterling, Politics versus the Bank of England and the UK Data. Thanks for listening.